Welcome, ladies and gentlemen, to my presentation, The Case for Moving Averages, the only trading strategy you will ever need. My name is Sal. Thank you for coming to my YouTube page, Supreme Penny Stocks. And ladies and gentlemen, I just want to reintroduce or introduce this time-tested indicator to traders who are not successful right now in the market or are looking for a way to trade that is time-tested. There are thousands of voices across social media who, in my opinion, don't have your best interest at heart and really only want your money. And we've got to understand that when it comes to trading, some of the best advice is available for free. Gentlemen who have lived and died before we were born, written books many times began before we were born, that are available for free, have talked about moving average strategies and have proven time and time again their usefulness. And I wanted to reintroduce or introduce that to you here today with this presentation, The Case for Moving Averages. So I have some beliefs about you that you have a basic understanding of trading. I should have had added here that you understand that not only do you already have a trading account or a paper trading account, that you buy stocks that are liquid, right? That you buy stocks that are popular, that people enjoy buying. And that you understand that the market is complicated. You also believe that successful trading requires a systematic approach. Now, why do we need a system? Well, we need a system because we understand that there are two motivating forces in the market, and that is the greed for the desire of profit and the fear of losses. And that results in us having two primary questions before we go into the trade, and that is when to buy or sell, and what to buy and sell. And I'm going to, I've created this resource to help answer that first question. That second question has a lot more, intangibles into it, where I don't know how much you have to work with. I don't know how much you have to dedicate to this art. So I'm going to answer that first question, and I think you're going to like my answer. So when we talk about a systematic approach, we got to understand that, the definition to that is a procedure based on experimental application of clearly defined and repeatable steps. Our goal of a systematic approach is to identify the most efficient means to generate consistent, optimum results. So this is not something that changes. This is not something that we're going to add here or add. No. This is a 1, 2, 3 step that I'm going to show you that you can apply to equities, you can apply to Forex, you can apply to many different trading derivatives that again, on longer time frames that are, make you successful and profitable. All right. So why is this necessary? Well, a strategy eliminates the errors of emotional biases. A successful strategy can also be back tested. Also, we've got to understand that a strategy, that has been scientifically reviewed by academic journals, proven to outperform buy and hold, and when slippage or the cost of trading is included, outperforms day trading. All right. So we're out of the day trading business here. If you're watching this, you're not a guy who's got, 10 hours a day to sit in front of a computer. You've got a life, you've got either a family, or you just got other things you enjoy, and you want to make big money. You want to make life-changing amounts of profit. And that's not sitting behind a computer. And don't get me wrong, there's some guys who do it successfully. But historically, when we add in the cost of trading, many guys who are day trading are not successful when you add in the cost. That's why they're so obsessed about lowering the cost of trading, switching brokers. They're with this broker the next day, they're with that broker the next week, because day trading eats away at your profits. More you trade, the more it costs you. Right? So let's explain the strategy. Again, the foundation is a combination moving average strategy, but with a tweak. The 50 RSI is the foundation of the system. The 25 moving average is what we use to open the trade. And the difference here, unlike a CMA or a combination moving strategy, the fast moving average is what we use to close the trade, right? So the crossing of the F50 RSI is the foundation of the system, over or below. The 25 moving average provides a visual representation on the stock chart of either support or the end of the current trend. It acts like the 50 RSI, but it's moving in between the candlestick on the chart. And again, the 10 moving average gives us the signal to close the trade, not to open, but to close the trade. So let's talk about going long and short. And I'm going to show you some charts here in a bit. When we talk about buying into strength, it's a 1, 2, 3 process. Identify that the trade is being taken as close to the 50 RSI as possible, right? As close to the 50 RSI. That's the foundation of we want to be as close to the 50 RSI as possible when we open and close this trade. We want to identify that 2 candlesticks have closed above the 25 moving average, and we want to close the trade once the stock closes 2 candlesticks below the 10 moving average. The 10 moving average. So let's see that on the chart now with only the 25 moving average being present here on a daily chart, right? So here I have WTW, which is Weight Watchers, from dates, I believe, April 15th to August 15th of 2018. And as you can see here, WTW provided 3 opportunities from April to June to get into the stock and profit generously on this trade. As you can see here, 2 candlesticks, we're taking this trade. 2 candlesticks close to the 50 RSI, we're taking this trade long here. Close to the 50 RSI, close to the 25 moving average, 2 candlesticks, we take this trade here. All right, now let's add in the 10 moving average as our signal to close the trade. As you can see here, the 10 moving average alerts us to close the trade. Why? Because it identifies the end of that short-term trend. The end of that short-term trend. So here, 2 closes below the 10 moving average. We're closing this trade. We got in 2 candlesticks below the 10 moving average. We're closing this trade. 2 candlesticks below, closing below the 10 moving average. We're closing this trade. How much would we have made on this trade using this strategy? Again, this trade is stock for stock here, but we understand that a 1% move in the price of the stock is about a 4.5% move in the option. So as you can see here, 9% change in the price, 15% change in the price, 20. These would have been generous returns on your investment and for an option trader. Very, very generous returns for an option trader. All right. Again, using the strategy, moving into the trade long, close to the 25 moving average every single time. Using, again, the 10 moving average as a way to close the trade, not to open, to close the trade. Let's talk about going short. Finding trading opportunities to the downside is exactly the reverse of going long. Exactly the reverse of going long. Again, we're going to identify the trade is being taken as close to the 50 RSI as possible. We're going to identify that 2 candlesticks have closed below the 25 moving average. And I don't know why I messed up on taking. I forgot the end there. But you guys know what I mean. Identify that 2 candlesticks have closed below the 25 moving average. And again, close the trade once the stock closes 2 candlesticks, this time above the moving average. So the only things that have changed, of course, is the direction of the moving averages. All right. So let's look at this shorting opportunity here. Ford Motor Company. Ford Motor Company on a daily chart, sending the signal here, 2 candlesticks below this 25 moving average. We would have taken the trade here. Here's an opportunity for us to short here as well. This was another opportunity today. Another opportunity at that time to short to short Ford as well too. But I wanted to make the most visible ones there. But again, taking the trade as close to the 50 moving average as possible. 50 RSI, as close to 50 RSI as possible. All right. Again, using the 10 moving average to close the trade. All right. I'm going to say you took that because Again, if you didn't follow or you allowed your mind to get to, you would have closed that trade. But technically, if you stuck to the rules, you would have stayed in there. You would have stayed in there. Definitely would have got out here. As you can see here, that kind of weak doji would have got you out the trade there if you held on a little bit longer. Right? If you held on a little bit longer, you would have got out the trade possibly at that level. All right. So again, the fast moving average alerts us to a change in the trend because we understand that a losing stock or a stock that's been going down for quite a while, it requires a change in the short-term trend to eventually become a change in the long-term trend. So on the downside, that 10 moving average acts as an alert symbol on these longer time frames and gets us out of the trade sooner. All right. Quite generous there. And as you can see here, this is the move and forward. This is the move and forward, which would have resulted in quite some very, very generous profits there for a trader. As you can see here, 3.5%, over 3.5% there, almost 13.5% at those levels. If you wouldn't have taken that trade, right? Being that you didn't take that trade and you actually, that's a 13.5% move. All right. And we're looking at about close to a 7.5% move if you took that trade here to there on forward. All right. This is forward on the daily chart. All right. So let's keep moving there. Excuse me. All right. So now we're going to talk about short term. We're going to talk about short term. Now, I don't like trading short term with this strategy. Although, yes, you can pull up some hourly charts. For example, TVIX, you can pull up some charts on several different types of stocks or ETFs where a short-term strategy would work using this strategy, right? A short time frame where this strategy does work. But we've got to understand that in lower time frame, it's a less accurate signal. Why? Because each candlestick represents fewer trades. Less information results in a lot of false signals, which leads to increased cost, risk, and more losses, right? Which basically means more slippage. And we want to avoid that. So I'm actually suggesting you not trade the strategy on a short-term basis. But is it successful? Yes, but there's just a shitload of signals. And I'm going to prove that to you on the next slide. Here's Facebook. Here's Facebook since that disastrous earnings report they're back in July. As you can see here, here's an hourly chart. As you can see here, I mean, just a mountain of false signals here. You know, this is the hourly chart. So imagine if I would have went to a 5-minute or a 10 or a 1 minute. It's just a disaster in amount of false signals that can really add up the cost of trading. Now, would you have been successful? Yeah, I can see some trades here where you would have made some money. But again, after you have added in all your cost, I don't know if it would have been worth it. I don't know if you would have been happy with what you got. So let's move up a little bit, right? So let's move up a little bit. Let's move to the daily chart. Again, moving to the daily chart here. Again, taking the trade as close to the 50 RSI as possible. We would have, held in quite a bit here. We would have held in quite a bit here and made a little bit more money. Obviously, Facebook hasn't sent the best signals since its horrible ER. But again, I'm going to show you how even in a higher time frame, you still would have made quite a bit of money. But as you can see here on Facebook, getting into and getting comfortable with a higher time frame will make you a more successful trader. I have learned that. Take it from somebody who used to promote penny stocks. All right. When I fell in love with these higher time frames, I got my time back. I started being profitable, and I started realizing that people who have real money, they don't trade day to day, ladies and gentlemen. They've got time to do other things, time to make money other places, and trading is just another way that they use common sense principles to generate significant returns for their portfolio. So let's go with Facebook here on a longer time frame. On a longer time frame here, one moment. And as we can see here, here's Facebook on a weekly. All right, so using the strategy on a weekly, I mean, again, increasing your time frame, each one is a week. So if you're going to do this This is a 19% move stock for stock. But imagine if you would have done this with an option. Obviously, you would have had to put some real time on that option. But that's money. That's money you would have made here on this. You would have damn near doubled the money of your option, right? You would have doubled your money here on Facebook, all right? So, ladies and gentlemen, again, just to sum it up, again, we're talking about using moving averages that have been, again, back tested. That, again, this is just 3. There are literally thousands of articles that have been written on using moving averages, and they have consistently outperform traders who day trade, traders who use buy and hold. Moving averages work. Combination moving averages work. But again, this is a tweak that allows you to be even more successful. I want to thank you for taking the time to reviewing and watching this presentation. Please, again, press subscribe. Send me a donation if you feel like you've made some money here learning this strategy and it's something that you plan to use in the future. I do have a link in the description. Stay tuned for my live shows in the future. Click that bell, subscribe, click that bell as well too when you subscribe so you can be notified of any future videos and live shows. It's your boy Sal. Thank you and take care.